When I think about mistakes now in the investment world, and this gets into my personal investment philosophy, but for me, when you invest in a property, you can do it for one of a few benefits. You can do it because you're trying to get a capital gain from it, where you're going to make a profit after you purchase and maybe you remodel and then you sell. You're going to make a certain chunk of money, or maybe you're buying it and you intend to hold long term and you're doing it for cash flow. Maybe you have a lot of earned income that you're trying to protect, and so you want to buy real estate in order to depreciate the value of that property to hide some of your other earned income, or maybe you're buying it for appreciation. What I would say is never buy for perceived appreciation if you're investing, because nobody knows the future. So I think that's a huge mistake that investors can make. And I would say, as far as long-term holds are concerned, especially in this current high interest rate environment, or what is perceived to be a high interest rate environment, it's really hard to cash flow now with, let's say, single-family residential real estate. And the most important metric that I look at when I'm purchasing something to hold long-term is I've got to have positive cash flow. I absolutely, do not want all of my profit or all of my gain to be locked up in a home. I've got to have a monthly income coming in. And what that monthly income will then allow me to do, if I'm having the spread between my mortgage amount and the maintenance and my property management company, and I'm still making a few $100s or $1,000 or whatever it may be after all of that is paid, well, that allows me in good or bad times to have that cash flow. So when the market deteriorates in the stock market or in the real estate market, you've got locked in cash flow that then you can use as a tool to pick up even better deals. But if you're buying and you have negative cash flow, as the market deteriorates, you don't even have the ability to get into that equity, and you don't have the cash flow coming in for you to make the moves that you need to make. And so it kind of goes to what Warren Buffett always says, is that when the tide goes out, you find out who's been swimming naked. And it's revealing. And I think if you look at the way Warren Buffett has modeled his investments, everything that he buys, he wants cash flow on. Number one, he doesn't chase growth. He chases cash flow. And then that cash flow allows him, when the market deteriorates, he's able to clean up and get things at steep values. And I think as real estate investors, it's a great model to follow. So I'm a CCIM, which is kind of the gold standard designation for commercial real estate agents in the world. And one of the things that I'm well trained on, and I think is very important in the commercial world, it's all about the numbers. You've got to, so I have a litany of spreadsheets that I use to analyze properties. And we can get into where, ultimately we know, I'm not going to say down to the penny, because to a certain extent you're forecasting. But based upon past history, we can get into what the true return on investment is going to come in at. And one of the things that we really look at, if you think about money in general, is, I would say that the best way to analyze money is using what's called a discounted cash flow analysis. And that discounted cash flow analysis, once I know my cash flows in a year, positive or negative, that discounted cash flow analysis allows me to look 5 years out or 10 years out on any investment that I'm doing, whether it's in the stock market, whether it's in commercial real estate, residential real estate, whether it's buying cryptocurrencies, whether it's investing in a business. And I can look at what my what's called internal rate of return is going to be. And I can compare between all of those, and I can decide between all of the investments at my disposal, what's the best outcome for me. Now, internal rate of return doesn't tell the whole story, because what you'll find in Northwest Louisiana, for instance, in the real estate market, is that some of the low-end homes, they on paper will show a higher internal rate of return than a high-end home. But I would say that there is a spiritual cost to every dollar that is made as well. And so for me, if I'm investing in the low end, a lot of times you have more maintenance and more issues than buying in the high end. And so I may take a lower internal rate of return to buy our higher end property to eliminate my time being in the deal or to eliminate future potential problems. So, but the internal rate of return is a great mechanism, and we're able to share that with all of our clients that are considering investments. We're actually able to analyze it for you and break it down. But it's a great way to know, am I going to make the desired rate of return that I'm anticipating? If a seller of a commercial property, let's say it's a multifamily apartment complex, and they're trying to sell their property and you're a potential buyer, well, a lot of times we'll do a non-disclosure agreement with the seller of the property if I'm representing a buyer. And then at that point, we'll ask the seller to turn over all of the P&Ls for the past 2 to 3 years. We'll ask for their Schedule E on the tax return, showing what they've really claimed on their taxes, not just the numbers that we've gotten. And then I would defer and actually say that I would use the Schedule E more so than the P&Ls at that point. And you know, you're going to have some people that it's not that they're being dishonest, but they've done a bad job bookkeeping. They're not built that way, where you've got to piece together the pieces of the puzzle and truly figure out what is going to be my expected rate of return on this thing. So, but yes, it is natural and expected to get all of that income and asset documentation for that property to where you can analyze it, expense data, capital expenses that have been made, to where you can decide and you can actually figure out what your potential internal rate of return would be using that discounted cash flow analysis. And then if the $500,000 that you're going to invest is best suited to be there, or is it best suited to just buy treasuries at 4%? If you're only going to make 5% and buying the apartment complex, and with the treasuries, you'll get a 4% return, and you don't have to do anything for the 4%, and there's no risk. Go buy the treasuries if that's the hurdle rate that you have. So I would expect if I'm going to buy an apartment complex, if I'm going to buy a commercial strip center, then I want a much higher rate of return than I can get through safer investments where I don't have to spend any time on them. Well, and generally with a discounted cash flow analysis, you'll assign what's called a hurdle rate to it. And so what that means is, if you were to if you promise me cash flows, if today I give you $100 and then you say this year you're going to get $20 back, and then next year you'll get 20, and the next year you'll get 20, and then the next year you'll get 20, and in year 5 you'll get your 100 back, and during the same time you've gotten $20 every year. Well, the $20 that I'm getting in year 3 is not worth as much as the $20 that I got in year 1. So I have to have a hurdle rate or an amount that I'm going to discount that cash flow back year by year. So everybody has their own hurdle rate. I would say corporate America would use 8% as their hurdle rate, and they would discount cash flow back in that manner. Generally for me, I'll look at what is a risk-free rate of return, what are some other places I can put my money, and what's my, where I can guarantee at least a 10% return. So maybe my hurdle rate is that. And so now the $20 3 years from now may be worth 20% less or 30% less than the $20 today. So I'm actually taking all of those cash flows and turning them into one number. And that one number tells me my net present value. What is all of these cash flows that I get for the next 5 years, plus the final payment when I sell? What is it worth in today's dollars discounted back to today using my hurdle rate? And then I know exactly how much I can offer for a property. I know exactly. And I know what I'll get as far as a return. So anything under that, I'm getting what you would call alpha, which would be a greater return than I anticipated, will be a way of saying it in a Greek way. So, we're not financial advisors, but we are, let's say, wealth advisors for the real estate side. I would say that's a fair thing to say. So part of our job, for investors is to help decipher all of that info that I rattled off that may be foreign to a lot of people, to help them understand exactly what they're buying and what they can anticipate for their future and for their family's future. It also, it allows them to look at, should I buy this industrial property? Should I buy this raw land? Should I buy this apartment complex? Should I buy Airbnbs? What should I purchase? And to me, it all comes down to, first of all, what is the internal rate of return that I would get from any of the ones that I just alluded to? But number two, how much time would I have to put into each? And so as another example, I currently have some acreage down in Keyfield, Louisiana, that I'm working on potentially developing into a manufactured home park subdivision. And one of the things that I'm wrestling with is not just the internal rate of return. What I'm really wrestling with is it's going to be quite a project. I'm going to have to oversee contractors, engineers. I'm going to have to put in a sewage treatment plant. I'm going to have to connect water or put in wells that can provide community water. I'm going to then have to buy the manufactured homes and put them on the lots and set them up. I'm then going to have to rent them out. That's a lot of work. And so then the question is, yes, even if I can make a great profit, do I want to exchange my time for those dollars? Or should I be in something more passive for that same amount of money? Is it better for me to go buy a growth stock in the stock market and take my chances there than where I don't have to spend a lot of time? So that's something that I do with every investment that I make. Yes, the commercial side is all numbers. The emotion leaves in the commercial side. When we think about residential, it's an emotional decision. Your family's going to live there. You're going to make memories there, or you've lived there a long time and all of your memories are here, and it's an emotional sale because you're selling home. In the commercial side, you can almost look at buying commercial property like you're just buying a money machine that's going to pay you a certain amount of money or a certain amount of cash flows. And so forget about if it's a skyscraper in downtown Shreveport, or if it's a manufactured home park development in Keyfield, or if it's an Airbnb in Benton. All of those are going to spit out a certain amount of cash flow. You're going to have to put a certain amount of investment up front, and then you'll have to analyze to figure out what you're going to get back. And it shouldn't be an emotional process. It's business at that point. If they're a novice, and this would be their first, let's say, big real estate investment property is going to be a big building downtown, then at that point, the first question they would have, hey, is this a good deal? Well, my response to that is I have no idea. Now let's sign a non-disclosure agreement with the seller. Let's ask them to provide all of the financial documents. And let's plug that in now into some spreadsheets to break down our net cash flow every year after all things considered. And then let's do a discounted cash flow analysis and figure out the internal rate of return. And then we'll know if it's a good deal, because a good deal is a big word. A good deal for me may not be a good deal for them. They may have a business where if they spend money on their core business, every dollar they spend, they make 20% on that. Well, if they're making a 20% return on that dollar, continue to put dollars there. Don't put dollars elsewhere if you can make a great return on something that is going to spit that out. So you exhaust that before you go look at other things. And once again, I would call that the hurdle rate that I alluded to earlier. That's their hurdle rate. And some business owners will approach me and say, hey, I am a tenant currently in a strip center or in a commercial property, but I think we'd actually like to buy rather than be tenants. And one of my first questions is going to be, well, what if you were to take the $200,000 that you'd have to put down on the next property, and you invested that back into your business? What type of return would you get on that if you invested it into your core business? And sometimes the answer is 20, 30%. Well, at that point, you're not going to get a better return than that by going and buying a property. It'd be a better outcome for you to invest back into your business and continue to remain a tenant. And obviously, does that help me as a commercial broker? No, I get commissions when they purchase and sell. But I just want to give truthful advice all the time. So I'm just going to give them whatever the truth is to help them make that decision. Currently for the Berkshire Hathaway brand, my business partner in that company and we are tenants in our building in the East Bank District. And we have talked about purchasing that building. And so I've done the same analysis that I've just alluded to on that building. And I found that if we were to go and purchase the building versus, being tenants or continuing to be tenants, we would make an 18% return. And so as I looked at my calculator, that's over a 10-year deal, and that's taken into account no appreciation. So 18% isn't bad. Well, then the other consideration, though, is real estate on a commercial level can be illiquid. It can take years to sell. So then the next question is, are we committed to, do we want to own that building and not have flexibility? Is 18% worth that to us to be locked in with a big mortgage and whether we move to another location, then we have to lease it out or sell. Do we want to, take that on? And so that's something that every business owner or every commercial investor has to wrestle with.
With buyers, y'all really, or on the residential side, you really want someone to be pre-approved before you even are going to entertain it. With the commercial side, is that the same process?
Yes, it is the same process. And a lot of times in the commercial world, you're dealing with cash buyers too. In the commercial side of the business, you'll find a lot of high net worth individuals. Commercial is not for the faint of heart. It's expensive to run the systems in a commercial building. If you think your utility bill of $800 a month at your home is high, wait until you get a big commercial building. Wait until the chiller or HVAC unit on the commercial building goes out and it costs you $100,000 to put a new one in versus the $10,000 at your home. So yes, generally as we're making offers, we are asking for pre-approvals, either from banks or stock account, showing proof of funds or cash or whatever it may be. So yes, it is kind of standard, especially before negotiations begin.